An employer-sponsored retirement plan is an excellent way to build wealth for working Americans. It provides tax advantages, allows your money to grow over time, and many employers even match your contributions. However, just like anything in the world, the job market is constantly changing, and many employees are wondering what will happen to their 401k or if they will lose it after they leave one job for another. Hello and welcome back to the Finance Guardian channel. You may lose some of it depending on the circumstances. That is why you need to know the rules, so you don't regret your decision later. And that is what we will discuss in today's video. So hit that subscribe button and the bell beside it and let's get started. American workers who leave their jobs and fail to decide how to handle their 401ks could lose up to $2 trillion of their retirement savings. If you don't transfer the 401k to your new employer's 401k or IRA, your former employer may move it to an unmanaged IRA of their choice. 401k plans are expensive to manage, and since you are no longer contributing to the retirement account, the employer forces you to transfer to an IRA to reduce costs associated with managing a 401k plan. When you leave a job, you may be at risk of losing your 401k balance if it is less than $5,000. This is because it is legal for employers to push out former employees' 401k accounts when they have a balance below $5,000. And if the participant has not given instructions on what to do with it, in most cases, these accounts are transferred to IRAs selected by the employer. It may seem that this move is intended to protect an employee's retirement money. Still, it can have unintended consequences such as depleting funds because of high fees and low investment returns. How does changing employers affect 401k plans? If you quit your job or leave for another, your former employer may choose to cash out, force a transfer, or retain your 401k funds. When you leave, the employer will force cash out if your 401k balance is below $1,000 and send you a check with the balance and taxes taken out. The check must be deposited into your IRA account within 60 days, or the funds will be considered a withdrawal, and you will be required to pay income taxes and a penalty if you are under the age of 59 and a half. The employer may transfer the retirement money from your 401k to an IRA of their choice if your balance exceeds $1,000 but is below $5,000. Prior to moving your money, the plan administrator will notify you. The employer will transfer the funds in accordance with the rules outlined in the summary plan description if you do not take any action. When determining the 401k account balance, the plan administrator considers the amount of money deposited into the account from salary deferrals and excludes funds rolled over from old 401k accounts. Suppose your 401k balance is $9,000, but out of that amount, $6,000 has been rolled over from a previous employer, meaning you have only made a total contribution of $3,000 from salary deferrals. The employer considers the 401k balance as $3,000 and not $9,000. Upon your resignation, your employer may transfer your retirement funds to a forced transfer IRA. Vested balance. It is important to note that any amount you contribute to your 401k, including money contributed via payroll deduction, cannot be lost. Even if you leave the company completely, the employer cannot take the money away from you. However, another portion of your retirement plan might not be available to you. Your vested balance, your employer may match your contributions, but the money may not be available to you immediately. This varies from employer to employer, but it is possible to wait 3 to 5 years before the matching contributions fully vested. You may lose some or all of the matches, as well as any earnings accompanying it, if you leave before you are fully vested. Hence, while matching contributions can be viewed as free money and help you reach your retirement saving goals more quickly, if you quit your job too soon, you could lose it. Before quitting, check your benefits information to see how long you have to wait for your vesting period. What happens to my 401k loan? Some employers offer retirement plans that allow you to take a loan against your balance. If you are particularly pressed for cash, you might consider this option. It is better than withdrawing early, which may result in tax penalties and a fine. But should you decide to leave your job while one of these loans is outstanding, you may find yourself in a precarious position. It is important to know that you do not repay the balance. It will be considered a distribution, which means you may still be subject to income tax and penalties if you are younger than 59 and a half. Additionally, your employer may require that the loan be fully repaid. You may lose money if you take a loan against your retirement plan, so ensure you are fully aware of the risks before proceeding. What happens if a 401k plan shuts down? You may be worried that your 401k might disappear if your employer goes out of business or ceases to operate. But under federal law, 401k assets are protected, and companies are required to separate retirement assets from their business assets. If a company goes out of the business and the management cannot use 401k assets to pay creditors or salaries to employees, funds that have not been yet deposited into a 401k plan such as those withheld by the company, are at risk of misuse. You must decide what to do if your employer shuts down and terminate your 401k plan to continue growing your funds. You can choose to cash out your retirement savings, but you will have to pay taxes and penalties on the money. Alternatively, you can transfer the 401k funds to an IRA account, saving you from paying taxes and penalties on the transfer. Additionally, this option ensures that your retirement funds remain in a retirement account, which safeguards them. Are your 401k savings at risk? Your employer deducts money from your paycheck when you make contributions to your 401k account and sends it to the sponsor for investment purposes. It is common for employers to deduct and withhold funds and only send them upon completion for a specific period, such as a month or a quarter. In addition, employers who offer matching contributions may delay depositing the match money until the end of the tax filing season of the year you earn the match. This risks your funds if the company goes out of business or files for bankruptcy during this period. You may also lose your retirement money if you invest your 401k in the company's stock. If the company goes bankrupt or closes its doors, its stock will have no value. What to do if your 401k is lost? When an employer shuts down, goes out of business, or is acquired by another company, it may be difficult to track your 401k. The following methods can help you locate your old 401k. Number 1. Search for your former employer. Finding a lost 401k account begins with finding your former employer. Contact the employer, specifically the HR department, to obtain the whereabouts of the account. Before an employer transfers 401k funds to a forced IRA, they usually mail the former employee to inform him or her about the transfer. You likely missed these notifications if your address changed and the employer transferred your funds to a separate unmanaged retirement plan because of this. Number 2, get in touch with the sponsor of your 401k plan. When your old employer shuts down its business, you should contact your 401k plan sponsor, whose name can be found on your old 401k statement. Contact the plan sponsor directly to find out if your 401k account is still active, or log into the provider's website. If you can't find your retirement account, ask the plan sponsor if it has been transferred to a forced IRA and where it can be found. Number 3, search the National Registry of Unclaimed Retirement Benefits. In case where your former employer and 401k plan sponsor are unavailable, you may try looking for your lost 401k in the National Registry of Unclaimed Retirement Benefits. This registry keeps track of retirement accounts that former employees left behind. Both former government and non-government employees who left balances in their old 401k accounts can use the National Registry. It is free and you can search the available records with your Social Security number. Number 4, go to the Department of Labor website. Alternatively, you can find the tax filings of the old 401k plan sponsor on the Department of Labor website. Search for the plan sponsor's Form 5500 using its EIN or plan name. In Form 5500, you should find the plan sponsor's contact information, which you can use to contact the sponsor directly to obtain information about your old 401k account. Number 5. Search the Abandoned Plan database. The DOL's Abandoned Plan database keeps record of retirement benefits from retirement plans that have been terminated by their employees. The database can be searched using the plan name or employer name. It provides the name of the qualified termination administrator who terminated the plan. The responsible party can then help you locate your 401k funds. And that is all the time that we have for today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new, subscribe to our channel to remain updated about our future videos. We'll see you next time.